Real estate prices are skyrocketing again, and it kind of looks like a repeat of 2021 or even hotter. But this huge spike in a short period of time is confusing for people to make better decisions. You want to get into the market, but you might be worried about what will happen once you get in. A stable and sustainable real estate market is actually better for everyone in the long run, and so big banks, regulators, and other real estate professionals are now chiming in on the issue in recent days. There's a lot of debate happening around what's really driving up real estate prices. Is it demand? Is it supply? Is it because Bank of Canada isn't raising interest rates fast enough? Is it because of investors? Stay tuned for our take on this topic and what it means for you as a real estate investor in Toronto. But before I begin, if you enjoy content like this, don't forget to give this video a thumbs up and subscribe to our channel so you see more videos like this made specifically for real estate investors in Toronto. We've been seeing these trends for the past 2 years. Freeholds have been outperforming condos. Sales demand has been outpacing supply. There's a divergence where prices are going up much quicker compared to rents, and there's been extremely good performance in the luxury real estate market and properties outside of urban centers. So what exactly is happening? Well, we all know that Canada is a great place to live in and therefore attracts a lot of new immigrants. We closed off our gates during the early part of COVID, and immigration recently reopened again. So now we're seeing a rush of new permanent residents come into Canada, primarily Ontario and the GTA since the summer. Some people argue that a lot of these permanent residents were already in Canada prior to the pandemic, so the actual increase isn't actually as high. Either way, immigration will continue to grow, and we will definitely need to continue to increase our supply to accommodate a growing population. When new immigrants come, the majority of them will start renting first, which pushes up the demand for rentals. But what isn't highlighted as much is the fact that we've seen more end-user properties being converted into rental properties during COVID. Homeowners needed more space, and many upsized their homes and moved to the suburbs. At the same time, they remain cash rich. So instead of selling their old homes, many kept it and ended up converting their older homes into rental properties because real estate makes a good investment and makes an even better investment when interest rates are at all-time lows. What this does is it ends up reducing the number of existing end-user properties and increases the number of rental properties, which has two effects. First, diminishing end-user home supply naturally causes an imbalance and will push the price of end-user properties up. The second effect is good news for renters. Since there's more rental properties now available for rent, this will slow down rent growth. On top of this, we also have other homeowners who don't need to move their homes, but also want to get into the real estate action. What is important to understand here is that even though the number of rental properties has increased over the pandemic, the number of rental properties available for sale hasn't really increased. So with more real estate investor buyer demand, and again, supply is not growing at a similar rate, this also pushes up investment property prices. And the cycle has been repeating itself throughout COVID. Low interest rates and high appreciation mean more people are able to refinance existing properties to buy more investment properties, which continues to push up demand and prices. So based on all of this information, do you think we have a supply or demand issue for real estate in Toronto? To answer this, we should probably split the properties into end user versus investment properties. For end user properties, it's most likely a supply issue. End user homes were converted into rental properties and they need to be replenished. Right now, that's not happening fast enough because it takes a long time to build a home and builders are holding back on construction because of material and labor issues. On the demand side, even though end user demand has been very strong throughout COVID, most people who want to upsize have probably already done so, and prices have gone up so much that things are getting out of reach. So when interest rates start to go up, this will put more downward pressure on their purchasing power and should naturally slow down end user demand and price growth, which mainly affects luxury markets and suburban homes that have gone up a lot more than core Toronto. For investment properties, and we're looking primarily in Toronto, What's driving up prices is probably a mixture between supply and demand. With a growing population, we do need more rental properties, but it's not been as bad because we saw a transfer of end-user homes being converted into rentals. And now, many people argue that it's not just a supply issue, but there's been a recent big spike in investor demand, which is a catalyst for the fast recent price growth. Now, the big banks are chiming in and telling the Bank of Canada to raise rates soon because that's causing an unsustainable growth in real estate prices and makes real estate as an asset class a lot more risky. BMO is saying there's an excess real estate demand created by the overabundance of easy credit. CIBC says that we're still in emergency interest rates, which make home prices more unpredictable. In my opinion, raising interest rates is more effective for curbing end-user homes, but might not be enough to cool investment property demand. If we assume a 3.5% net rent yield and 5% annual appreciation minus 3.5% in interest rates, after a 4.2 times leverage, you're still looking at a very attractive 21% in ROI per year. So if appreciation remains higher and the Canadian Real Estate Association actually forecasts 11.5% for Ontario for 2022, then real estate investing still looks very attractive and investors aren't going to back down. It seems like more and more people are telling regulators to look into curbing investor demand. So what's happening at the same time now, besides rate hikes, is that the CMHC mortgage regulator is reacting and looking into this. In their Fairness in Real Estate Action Plan, they're going to be developing policies to curb excess profits in investment properties, protecting small independent landlords and Canadian families, and reviewing the down payment requirements for investment properties. They say that they are targeting issues the market is facing from multiple angles. I want to highlight the down payment requirement, which I think will be pretty effective for lowering real estate investor demand. If you go back to our ROI calculations, if the down payment was increased to 25%, then instead of a 4.2 times leverage, it'd be closer to 3.5 times, which means the ROI will go from 21% to 17.5%. For a $1.2 million property, instead of $282,000 of capital, you'll need $342,000. And if you're pulling out extra equity from an existing property at 75%, this means your property price would need to go up by almost $456,000. In other words, this will definitely make it much harder for investors to get into a new investment property too quickly. Then, if this ends up cooling demand, we might see appreciation come back down to more regular levels of, say, 4% a year. And if that happens, we'd be looking at an ROI of 14% per year instead. This is actually still a very decent real estate investment return, but for sure, it won't attract as much attention as we're seeing right now. There are other ideas floating around as well, like not being able to use HELOCs as a down payment, which would make it an even harder barrier, but that's probably not even needed yet. Nobody knows for sure what's going to happen, but targeting investment property purchases might be a key tool to help stabilize our real estate markets. So based on this, what does it mean for you as a real estate investor in Toronto? The first thing is that stricter borrowing will likely soften real estate prices, but that doesn't mean real estate prices will tank by a lot. If you look at what happened in 2017 when they imposed the non-resident sales tax to slow down the super hot real estate market that was getting ahead of itself, detached home prices in general dropped by 10% in a few months. But if you look at the condo market or starter freeholds, there wasn't actually a big drop, but rather a slowdown instead. After a softening in mid-2018, starter freeholds in Toronto went up 10% in 2019 and another 6.5% in 2020. Condos went up a similar rate of 6% in 2019 and then almost 9% in 2020. And now, if there's going to be tougher down payment requirements, then investors will continue to flock to more affordable condos and starter freeholds, and also markets that haven't shot up as much, i.e. urban centers like Toronto. So we're likely to see a similar lower volatility environment in these markets in the short to medium term. The reality is that population growth plus a lack of land in Toronto means that fundamentally real estate in Toronto will go up steadily in the long run, and I believe Toronto will continue to outperform the rest of Canada. Just remember, real estate is not supposed to be a speculative class of investment, and a good balance of rental income and appreciation is a reliable formula for good, stable, long-term real estate investment returns. If you are looking for better leverage, this is a heads up that things might change soon for investment properties. CMHC has a track record of tightening financial requirements for investors. In 2010, Canada raised the minimum requirements for investment properties from almost no down payment to a minimum of 20%. In 2016, they took away default insurance, which increased the borrowing cost of investment properties. And so it is very possible that they will continue to increase things like down payment percentage or even capital requirements to taper real estate investor demand moving forward. We're big believers in long-term real estate investing, and if you want to chat more about this, we're ready for you. We can look into your requirements and preferences and then match you up with the best investment property that fits your needs. After we help you buy it, our team also provides renovations guidance, leasing, and property management if you need it. So just connect with us if you want to learn more about our services by heading to the link in the description below. Don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye!